America did not look like a country on the edge of collapse. Factories were running, railroads crossed the nation, banks stood tall in stone buildings that looked permanent and unbreakable. To most people, the system felt solid. But underneath that confidence, the financial world was fragile, stretched tight, and held together by trust alone. At that time, the United States had no central bank, no single authority to protect the system when fear spread. Banks were private, independent, and often reckless. They lent freely during good times and pulled back suddenly when trouble appeared. As long as people believed their money was safe, the system worked. Once belief cracked, everything could fall apart. The panic began quietly. A group of investors tried to corner the market on a company that owned copper mines. They believed prices would rise, and they borrowed heavily to make their bet. But the plan failed. The price collapsed instead. Overnight, those investors were ruined, and the banks that had lent the money were suddenly in danger. News spread fast. Depositors rushed to withdraw their savings from the banks connected to the failed scheme. Lines formed outside buildings that had never closed their doors before. Clerks counted cash by hand. Bank managers tried to look calm while wondering if they would survive the day. Fear did what numbers alone never could. It jumped from one institution to another. Trust companies, which acted like banks but were less regulated, were hit especially hard. One major trust collapsed, and its failure sent a message across the country. If one could fall, others could too. Without a central bank, there was no official rescue, no emergency money, no lender of last resort. The government hesitated, unsure of its role. Markets froze, stock prices collapsed, businesses couldn't get loans, workers feared losing their jobs, not because factories failed, but because credit had vanished. At the center of the storm stood one man, J.P. Morgan. He was not an elected official, he was not a government employee, he was a private banker. But in 1907, he was the only person powerful enough to stop the panic from turning into total collapse. Morgan called the leaders of banks and trusts to his library in New York. He locked the doors and forced them to face the reality of the situation. Either they worked together or they all failed together. He examined balance sheets, decided who would be saved and who would be allowed to fall. Money was raised overnight. Strong banks supported weak ones. Liquidity was rushed into the system. Even the U.S. Treasury quietly placed government funds into banks to calm the markets. The crisis slowly eased, not because the system was strong, but because a single individual acted as a central bank when none existed. The panic ended, but the lesson remained. America had come frighteningly close to disaster. The country realized it could not depend on one private banker to save the economy every time fear appeared. Trust alone was not enough. The system needed structure, authority, a backstop. In the years that followed, lawmakers studied what went wrong. They looked at how European countries handled crises and saw something America lacked: a central bank, an institution that could supply emergency money, stabilize markets, and act quickly when panic spread. In 1913, the Federal Reserve was created. Its purpose was simple in theory, but enormous in impact. It would be the lender of last resort. It would manage liquidity. It would prevent panics like 1907 from ever happening again. The Panic of 1907 is rarely remembered by the public, but its consequences still shape the world. Every central bank intervention, every emergency rescue, every market backstop traces its roots to that moment when America learned a hard truth: modern finance cannot survive on trust alone. Sometimes, the most powerful institutions are not born from success, but from fear.